7 words spoken from a podium in Ottawa has sent US Treasury yields surging, the dollar dropping over 3% in a single session and gold spiking to record levels as money fled everything connected to American debt. And the country that fired that shot was not China, it was not Russia, it was Canada. Let that settle before moving forward. The sequence began in the afternoon Eastern Time. The White House moved without warning. An executive order signed and released suspended correspondent banking relationships for 6 of Canada's largest financial institutions. The language was clinical correspondent banking relationships suspending pending review. The reality behind that language is not clinical at all. Those banks collectively hold nearly $5 trillion in assets. They are embedded across the American economy. They have branches along the East Coast. They serve millions of American customers, ordinary people, families running, small businesses, retirees with savings, sitting in accounts they assumed were safe. What the executive order actually did is cut those institutions off from moving US dollars through the American system. No clearing, no wire transfers, no settlements. The dollar pipeline shut. The calculation inside Washington was built on a specific logic that has worked consistently for decades. Control the dollar, control the outcome. Canada processes roughly $400 billion in US dollar transactions every single month. The belief was that cutting that pipeline would compress Canada's economy within 48 hours. Trade would freeze, banks would panic, political pressure would build, and Ottawa would come to the table on whatever terms Washington set. The theory assumed that whoever holds the reserve currency holds all the leverage. It assumed Canada had no alternative path. That assumption was wrong. And the reason it was wrong had been standing in front of cameras for months. At 5:08 in the evening, just under 2 hours after the executive order landed, Mark Carney walked to a podium in Ottawa. No visible agitation, no defensive posture, the cadence of someone who had been waiting for exactly this moment. He explained what Washington had done. He described it for what it was, the weaponization of the dollar system, the same mechanism the United States deploys against sanctioned regimes and hostile governments. Then he said something that will sit inside financial history for a long time. The president has decided to treat Canada as an enemy, not as an ally, not as a partner, an enemy. And then came the 7 words: Canada will now sell its US Treasury holdings. Over $300 billion in US government debt announced for sale into global markets. Not as panic, not as desperation, but as calculated economic counterpressure from a man who ran 2 G7 central banks and spent his career understanding every pressure point in the system. Washington just tried to weaponize against him. But that was not all. Within the same statement, Carney disclosed that Canada had already activated emergency currency swap lines with Europe, Japan, the United Kingdom, and China. Read that again carefully. While Washington was engineering a state mechanism to lock Canada out of the dollar system. Canada had already built a parallel network to route around it. Euros, yen, pounds, yuan, trade flows intact, banking operations, continuing the financial blockade rendered structurally ineffective before the markets even had time to price in the original threat. These agreements were not assembled in the 2 hours between the executive order and Carney's response. The groundwork was laid in advance. The deals existed before the White House signed the order. The counter was already in place when the strike landed. That is not reaction, that is preparation, and the markets recognized it immediately. Within minutes of Carney's statement, the US dollar moved down over 3%. That kind of intraday move in the world's reserve currency does not happen from routine volatility. It happens when something fundamental about the system's perceived stability changes. The 10-year US Treasury yield jumped toward 5%. The 30-year pushed past levels that make mortgage lenders recalculate every product on their books. And what follows from Treasury yield movements is not abstract finance. It is the cost of a mortgage, the rate on a car loan, the minimum payment on a credit card. Higher yields cascade through every corner of the consumer economy within days, not months. Analysts started warning immediately that average American mortgage payments could jump by hundreds of dollars monthly if the escalation continued. Washington went after Canada's banking system. American families absorbed the first financial impact. Bank stocks registered the damage in real time. Major US financial institutions fell between 8 and 11% in a matter of minutes. Investors were not pricing Canadian risk. They were pricing a question that the executive order had introduced into the system: if the United States will deploy financial exclusion against a NATO ally, a country with over a century of shared defense and intelligence infrastructure. a country that has fought alongside American soldiers in every major conflict since World War I. Who is actually safe inside the dollar system? The answer that markets gave to that question expressed itself in gold. It moved to record highs as capital left the dollar and sought shelter. When gold spikes with that speed and magnitude, the signal is not optimism about the metal, it is fear about everything else. The structural vulnerability that Canada's response exposed is the one Washington least wants to discuss openly. The United States does not run on current revenue. It runs on continuous borrowing. Trillions of dollars per year sold as Treasury securities to foreign governments, central banks, and institutional investors around the world. That system operates on one foundational assumption, that the dollar is the safe, neutral, reliable infrastructure of global finance, available to all participants on stable terms. The moment the United States demonstrated it will cut off a rule following allied democracy from that infrastructure, it altered the assumption. Every central bank manager who watched that executive order land is now running a risk calculation they did not have to run yesterday. If Washington will freeze Canada, it will freeze anyone. And if that belief spreads even partially across the holders of US Treasuries, the consequences are not recoverable in the short term. Three scenarios are now in play. The first ends with Washington pulling back within 48 hours under the combined pressure of American consumers, state attorneys general, Congress members representing border states, and financial institutions whose operations were immediately disrupted. The damage to trust is already done, even if the order is reversed. Canada's alternative payment network exists and has been activated. Every government that watched the sequence now knows it can be built, and it works. The dollar remains dominant, but visibly cracked. The second scenario involves neither side yielding. Canada begins selling $30 billion per week, perhaps more, into markets that are already reacting to the announcement alone. Yields climb past 5.5%, then higher mortgage rates push above 8%. The housing market locks, equities slide as borrowing costs crush growth projections. The Federal Reserve is forced into the market buying bonds to prevent a yield spiral, injecting liquidity that reignites inflation. The trade fight between two governments becomes a domestic financial crisis inside the United States, consuming the political space that initiated it. The third scenario is the one that takes longest to arrive and is the hardest to reverse. Canada demonstrates that operating outside the dollar system is survivable. Energy trade begins denominating in euros and yuan through bilateral agreements. Other countries observe, calculate, and quietly begin building similar alternative infrastructure. Not a collapse, a migration. Gradual, deliberate, and structurally permanent. The dollar does not disappear, it stops being the foundation and becomes one pillar among several US borrowing costs. Rise indefinitely. Not because of a singular crisis, but because the trust premium that made American debt the safest asset in the world no longer commands the discount it once did. The power of the dollar was never purely military or economic. It rested on a belief that America would not turn the system against those who operated within its rules. That belief took a direct hit this afternoon, not from Beijing, not from Moscow, from Washington. And a central banker turned prime minister just demonstrated exactly what breaking that trust costs.